We have another question that's come in here, and that is Secretary Paulson talked about the credit markets freezing up. Could you explain the role here of federal regional banks? Well, that's sort of a complicated, federal regional banks. I'm not sure exactly what, it looks like that's from David Scott.
Well, first, regional banks can be either state chartered or have a national charter, so I think maybe that's what we're talking about here. Yeah. But in general, the regional banks, at least in terms of stock price, if you look at some of the regional banks, they have not been beaten down as much as the larger banks because they serve a little bit different role. They were not big players into some of this.
Sure.
And so, in terms of the credit market freezing up, the danger if the government didn't step in, there'd be no money available. Well, there are still businesses that are ongoing. Everybody's not ready to shut their doors. Well, if you're an ongoing business, you have working capital needs, you have long-term expansion needs. So we need money to continually flow through our system to fuel the economy. So there was a real fear that all of this could just bring the availability of funds down to zero because everybody was so worried with the lack of confidence they were throwing all of their money into U.S. Treasury securities. So,
not even money market funds.
Not even money market funds, no.
Well, the money market funds were impacted by the decline of some of these investment houses, too, because they were investing in some of the debt owned by and marketed through these companies, these firms. Well, it's fascinating. One of the other things, if there's a slightly different take on what David was asking, if he was talking about the regional Federal Reserve banks, and they're talking about clearing credit, clearing from bank to bank, through the Federal Reserve. I'm not sure if that was the point of David's question too, but the thing I would add to this is that not only are we talking here about a liquidity problem in the U.S., but we're also talking about liquidity moving out of U.S. markets into other markets around the world. So part of the things that we're facing here is when we have credit problems in the U.S., it now becomes somewhat easier for people to wire liquid funds elsewhere around the world. So we're back to that interconnectedness that we talked about a little bit earlier. And I think that reduces the ability of the United States, particularly United States government authorities, to act alone. And so you saw, I think, not quite unprecedented, but really a very close degree of cooperation among central bankers around the world at the end of last week to get together to try to do some things in concert and let everybody know that they were working together in concert to supply liquidity literally around the world, which is absolutely fascinating to sort of watch this stuff unfold. I mean, it's costly for everybody around, and we all have to live in the real world economy, but for those of us that are academics who like to study these sorts of things, we don't want to see crises happen too often, but when they do, it's interesting to watch the way markets and regulators adapt. And I think in this case they were doing the right thing in coordinating and announcing what they're doing to help reassure markets and affect the reputational side of the markets, as well as actually supply that liquidity so they actually could sort of make things move through, but they also want to let people know exactly what they're doing.
Yeah, it's like $180 billion from the major countries of liquidity was pumped in, so we're talking a lot of money in a short period of time.
And signaling the willingness to continue to do that going forward. That's very good.
Absolutely.
Yeah, and there were some concerns about hyperinflation, but again, that's not a real concern if we're talking about what could happen, the consequences of a seized up financial system. So
I was actually thinking about the inflation, and some of you are familiar with the misery index. I know, Dan, you are, which is the sum of the unemployment rate and the inflation rate. And if our viewers would go and Google it, I can't remember, I think it's miseryindex.us or .net. I can't remember.
When did they first come out with that, John? Do you remember?
I don't remember the year.
My recollection is it was in the 70s when again, we were in a political election time, I think, with the Carter, Reagan, and they were adding these things up and came up with this misery index. And the thing that's starting to happen now is what we have always seen when the government, Federal Reserve in our case, central bankers supply relatively easy credit, as the Fed was doing through 2003, 2004, and later. And that is inflationary pressures building and pushing things up, so that now, if you look at the overall CPI, you're starting to see numbers that are crossing 5 and 6%. Even the core CPI, when you remove the particularly volatile food and energy prices, is still now up close to about 3%. You know, we're starting to see things trending upwards. And I'm afraid that if we're not careful, we'll get into the situation where those 3, 4, 5, 6% inflation numbers get built into longer-term interest rates, and they're particularly tough to sort of squeeze back down. We have another question that's come in here on the chat room from Roberto Fas. His question is, do you all think that the government will be able to recoup some of this, quote, welfare money to these financial corporations?
Recover some? Yes.
Yes, recover some.
I know that's a simple answer. Of course, some will be recovered. Not every bad loan that the government will acquire will default. Or,
okay.
You know, or even if they're in default, there may be some recovery of value. So even though we're talking that the estimates of the cost right now are about $700 billion, that's what it's going to take to buy all of these loans from these institutions. But then there'll be a recovery. It's just like anyone who handles recovery of bad debt. You know you'll be able to recover some. How much, we don't know at this point. But I would think there'd be some recovery.
Yes, and again, that depends on how quickly we can have some recovery in our real estate markets, the housing market. Again, as that happens, if we're successful with moving forward here, then that recovery has a greater chance of being maybe profitable for the government.
Sure.
Possible. As a taxpayer, I'm hopeful, huh?
Well, I think to look at this, we're potentially faced with a situation of a couple of bad choices. How are those defaults handled? How do we go forward? We have an immediate question of what does that do to the buyers and sellers of these kind of obligations. The second thing is that when the government gets involved in bailing these folks out in some way, shape, or form by buying the debt or guaranteeing something in some way, then you have the question about what happens the next time. So now do we have the kind of situation where free market forces are actually working, or are these free market forces that are then heavily influenced by an expectation of government intervention in some way, shape, or form? So it's not really a free market. One of the things I thought was very interesting last week, I saw an editorial, I think it was in the New York Times, complaining that we got into this crisis because of the problems of unfettered capitalism, which struck me as a little bit disingenuous, because all of these markets are both, A, very highly regulated, first of all, and secondly, very highly influenced by government entities being involved in the extension of credit or the guarantee thereof. So this is anything but unfettered capitalism. In fact, it is capitalism with many influences, some of which may be positive and some of which are not.
We have the most regulated markets in the world, other than, I guess, China,
yes.
of the industrial world. Yeah. I mean, you know, relative to, the financial markets in Great Britain and Europe, I mean, there is more regulation here in the U.S. So we do have regulation. It's not unfettered capitalism per se, but we do have, again, it's one quote was saying something about innovation sometimes precedes regulation. So again, sometimes there are innovations in the financial market that we haven't yet learned how or in what way they might need to be regulated, or increase transparency, improve disclosure, those kinds of things. That may be one area where some changes do need to take place.
Sure.
Well, one thing I think I can assure everyone, we will have legislation. One thing the U.S. Congress can do is pass laws. And anytime there's a crisis, they feel the need to pass laws.
Yes.
Sarbanes-Oxley, and you know, many people now, particularly in the accounting field, Beverly, say that maybe Sarbanes went a little too far, particularly for the mid-sized companies and the cost of compliance.
Yes, and they've backed off that as a result of that.
So I can, and this is just my gut feel, that we will see significant legislation that may go a little too far, and then after a few years we'll settle down and maybe they'll back off. But I would fully expect to see, well, we know there's going to be some legislation. Congress has been debating it today on what to do, how to structure things, and the political parties are going back and forth on things like limits on executive compensation, and you know, some of those provisions.
Some of the folks in the last couple of weeks have blamed incentive-based executive compensation contracts for some of the problems that we've seen at some of these firms. Do either of you care to talk a little bit about that?
I don't see, I personally, my view is that's not a big deal. I mean, certainly people make very big salaries. Of course, look at Fannie Mae. Look at Mr. Raines, who, of course, is no longer in that position. He had a nice little tidy package when he left. So, yes, they've been very high. Whether you can say that the pay of the top management caused all these problems, I think is a little bit of a stretch. Now, debating whether their pay was too high, that's a whole different issue. You could debate that when times are good or times are bad. You know, at what point does someone's pay become too high?
Yeah, I think executive compensation becomes a really attractive target because some of those numbers get to be so big that a whole lot of folks can't relate to them very well. So when you see somebody that's an executive getting a $20 or $30 or $50 million package, maybe for hitting an annual target that the next year it looks like wasn't really a sound long-term sustainable target, but maybe they met their stock price goals or sales goals or some other kind of goal in that immediate time, generating that big payout for them, and the next year something terrible's happened. That's the kind of thing that people look around and go, wait a minute, if that's what they did, how come this guy is walking away with a $30 million package and now we find out that his firm is bankrupt?
Yeah, I think just late this afternoon, I think it was the AIG CEO who was removed, was entitled, if he'd only been there 3 months, he left a $50 million job to take that over, and so he was entitled to this $25 million severance, but he announced he would not accept it given the circumstances. Of course, there was a lot of publicity about that for someone who's been on the job 3 months. But he did give up a pretty nice little job when he was convinced to take over AIG and try to turn it around.
Sure.
So.
Well, I think that this complicates things a little bit when you start having the federal government, the legislature, whether it's the House or Senate, putting together legislation to try to resolve this problem. So part of what you sort of see, and we saw a huge bounce at the end of last week in the markets, and now as it looks like over the weekend, some of the bailout, quote-unquote bailout package details start getting held up and slowed down. The financial markets had a tough day today because there seemed to be an expectation that there was a deal that was sort of worked out, and it seemed to be falling apart now as we enter back into the a reminder to everyone that we are, in fact, in a political season. It is a re-election or an election year for the presidency and a hotly contested presidential election.
That's very, I mean, I think that's adding one more little complicating factor. Let's face it. When you're in an election, both sides are doing some degree of political posturing with this. They're probably going to do it in any year, but I think given this fall's election coming up, it's probably going to be taken to a new level.
Okay.
So you have to be aware of that. And sometimes when you see some of our political leaders on the news, remember they may be just throwing out something there for the political expediency of the moment.
Well, this is what democracy is about, at least in part, right? If we talk about unfettered capitalism, maybe we ought to talk about unfettered politics as well. Okay, we have a few more questions that have come in. And here's a question from Norman Freeman that says, how will this affect our economy if foreign governments don't fund the bailout? Higher taxes? And do either one of you have any opinion on if foreign governments don't fund the bailout? I'm not sure exactly what that means.
Well, I guess they're talking about through the purchase of additional U.S. government securities and then the governments.
So foreign governments become increasingly unwilling to lend to the U.S. through buying government securities.
Right. If they begin to feel that we're printing paper, I guess, kind of thing, then it could be an increase in interest rates would be a possible result.
Higher borrowing costs.
Higher borrowing cost. And again, we're talking about raising the deficit to the level of, what, $1 trillion total with 700, you know.
It's a huge lump
number.
of, yes.
So it is hard
to
think in this election year as we're being promised tax cuts for 95% of U.S. Voters, if that's really possible. So, you know, I don't know. We will see higher taxes, but obviously somebody's going to have a bit higher tax bill somewhere.
Well, I don't personally often find myself in agreement with Paul Krugman editorials, and I certainly don't agree with the whole cash for trash editorial that he had in today's New York Times. But I do think there is a point on which I would agree with him, that is, if the government is rushing to go in and acquire hundreds of billions of dollars worth of debt, putting together a deal over the weekend to make sure that happens is something that we all might want to sort of take a deep breath and sort of look at the details of it rather than rushing on in. Okay, next question from Derek. Sunday's MTP, in addition to an interview with Secretary Paulson, I'm not sure what MTP is, also featured an interview with Michael Bloomberg and described a move to establish a single regulatory authority for U.S. financial markets, which Mr. Bloomberg might manage. What are the pros and cons of concentrating this sort of, or centralizing this sort of U.S. regulatory structure? And I guess what he's talking about here is in part the regulation of U.S. financial markets is fragmented among several different agencies. Right, the Federal Reserve has a role, the Comptroller of the Currency has a role. Who else has a role?
Well,
the Securities and Exchange Commission.
The FDIC, the Securities and Exchange Commission, and for intrastate securities,
and derivatives.
The state securities office, like in Alabama, the Alabama Securities Office. Insurance is regulated by states. Each state has an insurance commission or something like that. So depending on the particular financial product, you can have a lot of different regulatory authorities out there. So we, like Beverly said earlier, though, we do tend to be very heavily regulated, but it is fragmented. And that worked okay when insurance was totally separate from investments and banking. But, you know, the pros and cons, that's a difficult question to ask. We've never had a unified system. I don't know if they're asking, do we regulate everything, every single financial product?
It is difficult, and I can say from part of my experience working in one of the state regulatory agencies in Florida, the Florida Public Service Commission, it is very difficult to actually regulate industries very well. You have limited information. You have people at any of these places that are actually trying to do very, very difficult jobs. You also have the situation typically where the people working in those agencies could make a whole lot more money if they left those agencies and worked for the utilities or the other industries being regulated, and quite often many people do. So you have certain behavioral issues that get into actually the way regulation works. You have a whole set of economic theory about how regulation works, and then you have the reality of how regulation works. And in some ways, I think it is, although this is a sometimes controversial view, it is not necessarily a bad thing if you can have different regulatory agencies so that you can sort of see, here's how something works when it's regulated by the states, here's how something works when it's regulated by the federal government, and essentially have some sort of comparison and sort of watch what happens. And that, in large part, I think that's part of what we saw happening in the savings and loan issues, where you had some aggressive states trying to do some things, where Texas and California did some things where, in fact, if those had been done across the whole country, the savings and loan problem would have been worse than in fact it was, because they did some things that helped subsidize some particularly risky activities that when things turned south, folks got stuck with.
I would be a little concerned about a single regulatory agency just from the sheer size of the bureaucracy that would result. Without knowing any details, I mean, it could become a real problem there in dealing with everything.